Now, Japan right now, what's happening is about to affect your mortgage, your 401k, the US dollar, and possibly all precious metals. Japan's 30-year treasury bond yield just hit its highest level in the past 2 decades, and the 10-year bond yield reached a level not seen since 1998. That might sound like a story that doesn't matter too much to you at all, but when Japan holds over $1.2 trillion worth of US treasuries, that matters a lot because when their bond moves, when their bond market moves, ours moves as well. Now, to understand why this matters, we should kind of blame the Japan debt. First, understand how Japan became the most indebted country in the modern world and how this debt problem could cause a global chain reaction that hits your wallet, also your savings. Now, Japan's debt to GDP ratio is somewhere between 220 and 260%, depending on what data source you're using. That's the highest of any developed nation out there. And for context, the US sits around 125%. The economists generally start to get worried when theirs hits 90% or higher. That's because if debt to GDP ratio is over 100%, that means you owe more money in a single year than you can actually produce. Think of it this way. If you make 100,000 per year, you owe $90,000 in a single year. Your debt to your income is around 90%. So your debt to GDP ratio, there in that case, would be 90%. If you owe 125,000 while you make 125 or 100,000 per year, then your debt to GDP ratio is 125%, which is the same ratio as the United States. And in Japan, using their debt to GDP ratio, well, if you make 100,000, that means every single year you're owing between $220 and $260,000. That's a lot of debt that you have to service in terms of interest. Now, that's usually a huge problem. But for 30 years, Japan managed this problem with no problems because their interest rates were close to zero. Now, having interest rates close to zero or even negative is highly unusual. But why did Japan do this? It's because of the deflation that was occurring in Japan from the 1990s to early 2010s. In the late 80s and early 90s, Japan had one of the biggest asset bubbles in history. Stock doubled, real estate nearly tripled, and it's all due to the fact that it was fueled by cheap money and reckless lending. Famously, the grounds of the Imperial Palace were valued higher than the entirety of all the real estate in California. Now that was really crazy bubble. But what happened when a crazy bubble like that pops? In Japan, what happened was deflation occurs. Deflation is completely different problem than inflation. So in an inflationary environment, you expect costs of goods to go up in the future. So therefore, your purchasing power of your money has less value in the future. Deflation means that things will cost less money in the future. That's the opposite of inflation problem. So if things cost less in the future, then there's more of the advantage to me holding on to my money right now. Now, for example, at these vending machines, if the prices of those are going to go down in the future, I might just hold off and not buy them in right now because I would rather pay a little less maybe in a week or so. But there is in there that lies the problem. If people aren't buying things right now, then other businesses aren't able to sell things. If businesses can't sell their items because consumers are basically waiting for prices to go down, then the shop owners, they're not going to be being paid either. And when that happens, it causes a huge deflationary spiral. And this can last a very, very long time until the government steps in. Essentially, what happened was that this deflationary lasted for about 15 years, and then the government had to step in and then had to start borrowing money and spending money in order to kind of stimulate the economy. And I'm slightly, well, well, this, but essentially how the debt to GDP ratio in Japan got to where the levels are right now. Japan has two separate institutions, and this is where it gets pretty interesting in my opinion. So first, they have the government, which borrows money by issuing bonds, and then you have the Bank of Japan, which is a central bank. They're technically independent, kind of like how Congress will spend the money, and the Federal Reserve will control the monetary policy. To keep the cost of their debt manageable, the Bank of Japan kept interest rates close to zero. But then they still did not really solve anything in their deflationary problem. So what they had to do was they had to launch what's called quantitative easing. Not only did they print massive amounts of money, they kept their interest rates at zero and sometimes even negative. And they also introduced something called yield curve control, which is where they capped how high the bond yields could be. Now those stats are crazy. So the Bank of Japan now owes 50% of all government bonds. For the 10-year bond is particular, they own 90% of the entire bond market. This means the Central Bank of Japan here is essentially the owner of the entire bond market. When you have your central bank buying the majority of the bonds, that pushes bond prices up artificially, and then yields come down. So even though Japan owes 8.6 trillion dollars, the cost to service that debt is virtually zero because the central bank keeps buying those bonds and keeps their rates nearly zero. This all tends to work in a deflationary environment. But what happens when inflation arrives? Well, some people are saying when inflationary expense, about say 10% for say a rice ball, used to cost 120 yen. Maybe these days it's closer to 135 to 140. Now this doesn't seem like a huge deal, especially if you're American, because you've been experiencing inflation for quite a bit of most of your probably your adult life. But in Japan, this is a relatively new phenomenon. Japan's current interest rates sit around 3%, which is not a really good thing because the Bank of Japan can't really afford to keep rates at zero if inflation is going up. They need to do something about it. In the United States, the Federal Reserve increased interest rates in order to combat inflation. And the Bank of Japan, they had this idea instead to reduce the purchases of the bonds. And by reducing their purchase of bonds, the yields would naturally go up. Now, the problem with high interest rates is that the cost of service debt is now $230 billion a year. And that 25% Japan overall budget. According to readers, while tax revenues are expected to keep rising, they will not be enough to pay for a steady increase in spending, as a rapidly aging population and rising long-term interest rates push up social welfare and debt servicing costs. So the trap that they're facing is following. Number one, you either raise rates to fight inflation, and then the debt services cost too much, or you just leave the rates artificially low, but then what happens is the yen will collapse in value. And then you have a currency crisis instead. Now, if this just happened in Japan, if this is just a Japan problem, we probably wouldn't care much. But it's not just a Japan problem. And here's why. As Japan bond yields go higher, they actually become more attractive to Japanese institutional investors. For years, when interest rates were close to zero, Japanese institutions like banks, insurance companies, and pension funds, they would actually borrow money from the Bank of Japan for virtually zero interest rate. And this created an opportunity for what's called the yen carry trade. Japan's institution or other institutions would borrow money from the Bank of Japan for near virtually zero interest rate. They would convert it to US dollars, and then they would take those US dollars and invest them in US treasuries or things like US stocks. And the idea was pretty simple. If you could borrow money at 0%, but you could earn a yield of 5% in the United States market or in the US treasuries, then why wouldn't you do that? And this arbitrage play works as long as the math remains favorable. However, right now, we're seeing the Japanese 10-year bond yield sit around 2.1 to 2.2%, and the Japanese 30-year yield sits around 3.3%. However, that reaches almost 4% early last month. Because of this, the difference you make between borrowing in Japan and then buying US treasuries or US stocks, that shrinks a lot. So here's an example. Let's pretend the Japanese pension fund borrows $1 billion worth of yen at 0.1%, and then they buy US treasuries that are yielding 4.5%. That's a 4.4% or 4% spread. That means they're essentially earning $44 million a year in profit just by using this arbitrage play. But now you can borrow at 0.1%. You can't do that anymore at 1%. You're paying 2.1% for the 10-year and 3.3% for the 30-year. As well as you have fees, currency conversion costs, currency hedging costs. The spread between the two shrank quite a bit. Now the free money is essentially gone. And so if you were an institutional investor in Japan, why would you take on this currency risk when you could just invest in your own bonds? And that is what's happening now. Well, this is called the unwind risk. That's when investors who borrow yen to buy foreign investments, they're now facing higher costs. And so what do? They want to unwind those investments and just invest in Japan instead. In order to reduce risks, you have these Japanese institutions. They are selling off their assets. They're converting their dollars back to yen, and then they're paying debt. They're down their debt, and this does create a huge amount of selling pressure downwards on the U.S. Treasuries. Japan is the largest foreign holder of U.S. government debt, holding between 1.1 and 1.2 trillion dollars worth of U.S. Treasuries. And they sell these treasuries, that pushes the U.S. bond yields higher. And in America, if you have higher treasury yields, that means a lot of different things. Higher rates means that if you're trying to buy a new house, things are going to get much more expensive, especially with your mortgage. So even a 1% increase on mortgage rates on a $400,000 home, that adds roughly $250 more per month to your monthly mortgage payment. Now, over 30 years, it's over $90,000 in extra interest. Number two, when interest rates rise, that could actually hurt U.S. stock valuations. Companies start to borrow less. And the way that investors value stocks, that actually changes quite a bit. A lot of companies in the U.S. are valued based on a discounted cash flow model. They basically take future earnings and then they discount them to the present using an interest rate as a baseline. When rates go up, future earnings are actually worth less today in the discounted cash flow model. So even though a stock or a company is doing quite well and profitable, you could still see the stock prices drop. And also, when interest rates rise, that doesn't really help the U.S. government either, because the debt to the GDP ratio in the U.S. is still 125%. The cost of servicing American debt will go up if interest rates go up as well. And that means less tax revenue for things like infrastructure, defense, programs that actually help people. Now, everything I described so far today would be pretty bad on its own already. But Japan is facing two factors that make their situation even more dire. Factor number one is population collapse. Japan has an aging population. The current working age population in Japan, those between the age of 15 to 64, make up about 59% of the total population. That's actually well below the global average. And Japan's population is also declining. So in 2010, they had around 128 million people. But that's less than 122 million. By this year, by the year 2100, projections actually have their population around 75 million people. And you can actually see it there. I know that I don't know people in Japan myself, but I've heard multiple stories about the reason why the population is decreasing. And it's a lot to do with things that we can't talk about on this channel. So last year, Japan's recorded fewer than 687,000 births. And that's actually the fewest it's been since they started tracking it back in 1899. And so this aging population actually makes the debt worse, because if you think about it, there are fewer workers, which means that there is less tax revenue coming in. Fewer workers means less GDP growth, which means that the debt to GDP ratio is actually getting worse, even if the debt remains flat. The second factor is that almost every country in the debt right now, so Japan is not the only country dealing with the debt problem. Multiple countries are. The US is at 125%, as we talked about earlier. The UK, France, Italy, they're all running massive deficits right now. I wouldn't even say that there's more government debt in the entire world right now than at any point in history. So if Japan were the only country with massive debt levels, I think that would be one thing. But you think that the global market could probably absorb some of that. But every major economy is competing for bond buyers at the same time. Now, the US needs buyers, Europe needs buyers, Japan, multiple different countries need buyers. And there's only so many bond buyers to go around. If Japan institutions continue to step away from buying the bonds of the United States government, then this is a huge buyer that is leaving the bond market of the United States. So you've got a debt crisis, an inflation problem, and an aging population problem. And you also have a compounding global debt issue. All right, so where does this go from here? I think there are three scenarios. The first scenario, I think it doesn't really go anywhere quickly. Japan will slowly raise their rates. The markets will adjust gradually, and the world will adapt. This is known as a soft landing, and I think this is the most probable outcome, only because Japan has been managing this problem for over 30 years. The Bank of Japan is smart, and hopefully they move quite slowly. They're able to normalize their inflation rates and also service their debt and basically stabilize everything. The second scenario that I could see happening is that the carry trade has a negative consequences. So if Japan's yields spike faster than they're expected, like let's say they go to 4, maybe 4.5% or even 5%, then you're going to have that unwinding happening with institutions are selling off their US treasuries at a very rapid pace. When this happens, you're going to get selling, which will trigger more selling, and that will create that chain reaction that I talked about earlier in this video. We actually saw a preview of this in April of 2025 when Japanese investors they dumped over 20 billion in foreign bonds in the matter of a week, causing the stock market to dip. This could especially happen if there are some geopolitical shocks to the system. So, for example, if things escalate in Taiwan, or today, I've been reading news that I saw that there were airstrikes over in Iran when we hear multiple stories about it's coming to an end. But I guess until it's over, there's going to be strikes, and we have to be concerned, but feel that the end is near. And I've been also receiving data that China has moved multiple ships away from Taiwan. So if something actually happens in Taiwan, it would be a real shock because it looks like they're pulling away and they're not willing to fight. China has multiple problems with their government as well. The Bank of Japan has to start printing more money, and then you get some sort of hyperinflation scenario like you might see in countries like Venezuela. However, I think the most likely scenario that ends up happening is scenario number one. That's the slow grind, slow soft landing. Either way, if it plays out fast or if it plays out slow, Americans are going to feel that difference. They're going to feel it through higher rates, more expensive housing, perhaps a dollar that doesn't go as far as it used to. And we're experiencing multiple problems with that. The era of cheap American borrowing subsidies by foreign investors is coming to an end. And that's something worth paying attention to. I'll be keeping an eye on the situation and keeping you guys updated the more I hear. Let me know if you enjoy this video. I do appreciate you stopping in. Try to have a great rest of your day. God bless. God bless your families.